confirmed. All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's check-in for, this is like session 5 or 6. Let's see, May 18th, 2023. So the only question there was from Brian. And Brian, good to see you guys, by the way, you and Craig. Oops. And Brian's question was, let's see, struggling about getting to no lose plus dinner for two quickly versus trusting the PSAR. Point in the right direction. And a potential issue of wanting to be right instead of relying on the re-entry. And so this is my initial response was really, look, trade one share live, because the first place that the tension usually appears is, after a person has sort of internalized the rules with back testing and paper trading, and then starts trading live money, that the addition of the skin in the game generates a new source of self-talk and noise that usually comes from trading at too large of a size. When that happens, it's usually because of the problem of the pessimistic mind versus the practical mind versus the optimistic mind. If we said something like, some kind of bell curve, most of the time we're in this practical mind as traders. But every so often we get, new ideas, and we get very optimistic. And then we investigate that, and we say, there's a lot of goodness in there. And so my optimistic mind says, hey, I can trade that particular pattern, and it's going to be all good, and there's all this joy. And I understand that there's a 1 hour stop. So when I make my entry and I respect my 1 hour stop, still I'm going to see that. We remember all the instances where that happened. And then when we accumulate enough evidence, that's enough to persuade our practical mind that, this thing is actually tradable to test out. We might have even invested in some back testing. And maybe even some forward testing with out of sample data, So what you want to do is have some back tested data, and you might have trained the rule set on those data sets here and here, but you preserved some out of sample data that you then, so you generate rules based on these, and then you test the rules on that set. So now I'm not curve fitting to the old data. And then you might be also forward testing with live data. And if the rules still are prove out, the expectancy and the histograms are approximately the same, then I've got enough evidence, and now my practical brain really wants to go. And then if you've done all that, it would not be abnormal to say, look, I've done all the back testing. I'm just going to go to the position size. I'm going to go right out here to the maximum level that I can even optimistically tolerate. That's like the absolute upper limit of what I can get away with. And a lot of that decision to move from the testing phase to instant maximum production comes from, in some cases, just, hey, how much evidence did I accumulate in the testing phase, and then I put significant money on it, and I'm already out here. Well, Once you get that kind of position sizing on, your pessimistic brain comes along and says, hey, wait a minute. And if we think about, I talked about that this weekend. If we think about the walking man and the 5 ways of knowing, the knowledge of the head is that rational brain. Knowledge of the heart is the identities and value. Knowledge of the gut is the risk brain. It's emotions based and intuitions. And the risk brain is concerned with being surprised in this close in space. Whereas the knowledge of the heart is concerned with identity and alignment and in your purpose and all that stuff. And then the knowledge of your head is concerned with this rationality. Testing of the rules in a specific case. Well, what the gut does, the knowledge of the gut is the one that is concerned about exaggerated risks, and it jumps at every shadow and says, hey, I'm not technical and all that, and I don't know exactly what you did in all that testing, but I'm not persuaded, and I'll never be persuaded that your test was as complete as this dynamically changing world. So there's always some tiger out there that was savvy enough not to appear inside your training data and test data and forward testing data. There's some kind of little bogey out there, what Taylor would call a 4th quadrant problem. So the knowledge of your gut is saying, look, I'm not persuaded that you've taken all of the precautions that we should or could. And I'm concerned about those, about being too large. And so what'll happen is once you get inside these early stages, when you're trading it with real size, you'll start hearing questions coming from your risk mind, and you'll start making intuitive snap judgments that override your rule set and become provisional rules. And if those get rewarded, sometimes you end up amending the rules based on feelings and small data sets. And then you end up with a rule set that started off as formal and tested and then becomes this god-awful hairball of feelings and exceptions to the rule. And, well, I maybe going to try this, and what if and I'm going to add indicators and more if-then. And so you're never in a position, if that happens, to have just a stable machine that's producing results that you can just go in and tune according to some simple, straightforward rules. So the issue of struggling with how soon to move to no lose plus dinner for 2 sometimes can come from that. And if it doesn't today, it will in the future. That's why I teach down here that when we forward test, as soon as possible, start with 1 share and risking $1, and then start slowly building up on the basis of real live trading and performance at levels of position sizing that are obviously very small, that do not represent any kind of existential threat. And then you get real practical experience in what it's like to trade with skin in the game going forward. And then you can scale into what I would call finally full production. And so for me, full production is $400 a trade. But I'll start with $1 of risk and then increment in smaller steps up to the point where it gets to 400. And that's about where I'm comfortable at, have been comfortable there for a long time. And I would rather take more trades at the same time at a standard level of risk and a standard level position sizing than trying to scale that too much, because that starts throwing me off my game. Because I have a lot of experience trading at that level, but not as much experience as trading at 800 risk per trade, something like that. So there's a certain comfort in standard work. So I say all that just to say that one of the sources of the tension between just following the written rules and that desire to override is where does it come from? One of the reasons is you're finding new systems based on your optimistic mind. You're kind of then proofing it with your practical mind. But even then, your practical mind can get influenced by your optimistic mind, and you start looking for confirming data as opposed to disconfirming data. So I should be trying to disprove rules with my practical mind rather than trying to prove that it works. I should try to find why it doesn't work. Now, if I've done that I've actually taken an important step towards calming down my pessimistic mind that says, "Hey, I've got a reliable process that you can just relax a little bit." But no matter what, at some level, all of the rationality is not more persuasive to your pessimistic mind. Like all the cool, calm, carefully reasoned positions with all the evidence in the world that's coming from rationality, at some point there is some wall in between that just says, "Look it, dude, more evidence is not persuading me. There's something, it's the part of the world that you haven't studied that I wonder about, that I worry about. The places where tigers are coming from, not the places that you've investigated." Like, you can't investigate all the places that tigers can be because tigers are too smart for you. So there's a certain level of distrust. So that's one of the things that could be the source of the tension. Another one might just simply be, "Hey, I haven't committed the rules to a very specific set and said I am going to execute that with a checklist mentality, and I'm just going to follow that strictly." So if you're kind of bouncing around, like you just have, if I have a working knowledge or a feeling of how I feel like wanting to exit according to some strategies, then what you may be reacting to is again the fear mind or the inner guide saying, "Look, you haven't committed. You have not done your due diligence and really specified those rules. And all I see you doing is what you feel like. So I'm going to help you by giving you more things to feel," which is what I do. The fear mind is really good at feeling. So if you're going to operate on feelings, you can just count on the fear mind coming over the wall and saying, "Here, I'm here to help," whether that actually helps or not. So that could be part of it. So one of the simple things that I would say is, "Here, look, commit to the rules. Write them down and then study them and get 30 examples of following exactly that rule and seeing what it actually produces." And say, "Hey, well, I've got a couple variations of that rule." Then I would tell you this. Then take exactly the same trading case and run it strictly with each little variation of the rules, A, B, and C, for the 30 same trades, and say, when I apply rule A, this is the result I got. In B, I get that, and C, I get that, and otherwise everything else is exactly the same. When I enter, what target I'm taking, the time of day, and all that stuff. The only thing I'm going to vary is the exit rule. So now, if I've done that due diligence, I'm now in a position to say, "Hey, which one of those gives me the kind of results that I want?" And that could be numbers, but it could also be how I feel about it. And you can start studying the histogram, and you can prefer one histogram or another. So that may be a source of tension. The other source of tension, I would say, is it goes back, and I'm going to repeat what I said before about the PSAR flip. just as the example, when I said, look, I've been probably teaching that wrong, that if that's going to be your risk box, what that really represents is a yellow zone, and that any price action inside here is in the noise zone. There's no signals inside there. You don't get a signal until it leaves that risk box, which is a signal to go long or a signal to go short with a collapsing dragon, or it went long and then exited and then a stop and reverse with a CD. Those are clear, precise, codable rules. So if that yellow zone represents the noise, and now you're moving, the stop or the price is going up like this, and then it's that first 10 bars where it gets really tricky. And so I'm going to talk about ways to exit here in a minute. But one of the ways that you can calm down that tension is just to say, instead of setting that exit here to -1 and then trying to figure out rules that would allow you to reliably exit inside the noise so that you only take an average of 0.6, you're really working at cross purposes. You're introducing uncertainty because according to your hypothesis, this is the first place I'm going to get a signal, and yet I'm trying to find signals in an area that I defined as noise.
Right.
And that psychological disconnect is the real source of a lot of tension. So there's really two ways. If you looked at this and here's some numbers, if you go back and listen to the Devon Energy swing trade that I framed on Sunday in the Creativity 202 course with Kyun, go listen on Sunday, 0514, the Creativity 202 lesson. I think it's 12C. And it's on Patreon too. And in there, what I said was, look, he was kind of having this same issue. And I said, look, on the 30-minute chart, the PSAR flip was a trade that I took in Devon Energy, and the risk box was like 50 cents. And then if you looked at it on the 3-minute, the MMRB was about 18 cents, which times 3 is equal to approximately 50 cents. So if I'm on the 3-minute bar and I get some kind of entry that's based on a PSAR flip, which was a thing that I did on Devon Energy intraday, it's the same pattern, and the entry got me long here, and there's an 18-cent box. If I take that and map that to the 30-minute bar, the 3-minute exit would have been a signal to get out right here. But the difference is that's an absolutely codable, cut and dry, black and white exit rule. He doesn't like trading that fast. So what we did is we went out and looked at the daily and the 3-day. And we took a look and said, hey, look, there's the same pattern setting up. And the entry level was kind of still the same. They were all entering right at about that level. It just happened to be. And on the daily bar, this was something like $3. So his risk manager felt like, man, I don't have any worry about taking more than a 1-hour loss on a $3 risk. We said, all right, make that your position sizing risk, and trust your risk manager to say, what is the level of position sizing risk that I can take where I can sleep like a baby and I promise not to come over the fence and bug you about when to move your stop according to your technical rules. I know you're busy trying to drive the car, so I'm just going to sit in the back seat and sleep. And I said, well, for him, when he investigated, it was the $3 risk. So what we worked through was the logic which said, look, let me just put that on the 30-minute chart and make that a minus 0.6 loss. And then I feel comfortable never exiting inside the yellow zone there. And I will ruthlessly execute there. And I'm happy to only take a 0.6 loss. And there are 3 of those 0.6s available to the upside, which we did when we did the rational mind for framing the trade on the reward side. When we looked at the reward, it turned out that there were like 3 levels of risk and reward on the 30-minute bar, and only going back like 10 days, such that his little 50-cent risk, there was 2 of those just to the first level of resistance on the 30-minute bar, and that there was like 6 on this one and 13 on that one. So that if you used your optimistic mind, there was really like $6.50 of upside move to the 10-day high. And he was only taking a 50-cent risk with his rational mind on the 30-minute bar. And so he was absolutely persuaded that even with his conservative mind, there was a 2-to-1. There was $1 of upside reward compared to the rational 50-cent risk. So his rational mind was absolutely convinced with an optimistic, a realistic, and a conservative view that this trade was qualified to be taken at a 50-cent risk, and his rational mind was sure that he wouldn't take more than a 1-hour loss. But it's not the rational mind's risk that's on your mind when you have skin in the game. Because your rational mind is only concerned about this instance of this trade, whereas your fearful risk mind is concerned about all the tigers that it hasn't seen. So you have to have a negotiation with your emotional mind, your feeling mind. And it turned out that the $3 risk was what he wanted to take to be comfortable. So he said, all right, position size off of $3. So if you're going to risk $400, to use my example, you divide that by 3, you could take 133 shares. Okay? Because he's risking $3 on the daily chart. Now, if I was going to position size with the 50 cents, I could have 800 shares. And now that is a difference that'll get your risk manager's attention. You're 6 times as large. And so that makes them more nervous, not less nervous, even though you've got all the rational analysis in the world that says that's an acceptable risk. Yeah, it's an exceptional risk to the guy that's not paid to make that decision. The guy getting paid to make that decision is not the knowledge of the head or the heart. It's the knowledge of the gut that's making that decision. And the knowledge of the gut is taking its marching orders from your heart. And it says, hey, the purpose that I'm trading is so that I can create wealth and safety and comfort for my tribe. And I live for those people and my sense of duty to them. And that's out to 200 years. So when you're taking, he says to the risk manager, when you're making your judgment about what's risky or not, acceptable risks, you keep in mind that we got a 200-year time horizon and we're trading for the estate for our children. Whereas your rational mind is saying, hey, I'm looking at the next trade that I'm going to take in the next couple of hours with $400. And I've proofed that the risk of that trade. Whereas the risk that your risk manager feels is, man, what if you're successful on that trade and then you're going to start cutting corners and trying to get too large too fast like you always do? And then you're going to be out of control like some kind of drunken crack addict, gambler, maniac, you know. I've seen you. I don't want to do that. So that only makes it even more risk averse. And so it says, look, have you thought about moving your stop to no lose sooner to get my risk out, and then it jeopardizes the trade because you moved it up too close and it taps out, and then it just keeps going, and you say, oh man, I never should, and then you start trying to make those corrections on the fly, and all that is doing is making a lot of noise. So the thing to listen to was that it was almost an hour-long discussion with Kuhn, was to talk about have a strong dividing wall that's being operated by your chief of staff. Right? And that's the guy who's assembling and managing the team. And then you have your reward analyst do all the things he's supposed to do to frame the trade according to the rules and go through all this analysis and figure it all out. Take a optimistic, a conservative, and a routine and say, does this still check out? Very good. Done. And then you leave that room with your chief of staff, and then you come over into the risk room. And in the risk room, you know, what you're going to do is you're going to talk to that guy and say, look, I've got a trade that I'm going to make sure that those guys execute according to plan. But all I need, and you don't even need to know the details, what I want you to do is to move out a couple time frames. Go up 2 time frames, if that's what it takes. Go up 2 time frames, from the 30-minute to the day. Skip right over the 2 hours. Go to the daily chart or the 3-day chart, and you tell me what level of risk you feel comfortable taking. Maybe it's $3. But whatever it is, I want you to be satisfied because I'm paying you to manage my feelings of risk. You're watching out for the team for the next 200 years. And you cannot be too risk averse for me. So I want you to persuade me that you have not a crazy risk, but a reasonable risk as expressed by you and your feelings of what we're competent at. Because you're watching us do our due diligence. You're watching us take the shortcuts and whatnot. So when you're satisfied, I'm going to position size off of that. But I'm going to execute. Once you've told me that, my position sizing is done. Here's your banana. You can go back to sleep. Now leave the trader alone. And trust me and the fireman that as soon as they put that trade on, I'm going to find a way to get our risk out. The risk to the core capital. And I'm going to get to no lose plus dinner for 2 as fast as I can based on the rules that we have tested. I'm going to do that with the fireman. That's not my optimistic mind. That is a trained professional who manages that risk for me. So that's the mindset that we've got to develop, I believe. So far, so good?
Yep.
So now if we set that noise box on any time frame, we say instead of 1 point, we're just going to set that equal to 0.6. Now I have much less anxiety in the yellow zone, so that if that thing starts failing, I don't cut it too soon and then watch it go back up and then try to sort out. But that's also the same mindset which says, hey, it started moving in my direction, and now that it went that little bit, I don't want to lose money, and so I'm going to hurry up and try to get to no lose plus dinner for 2 right away, and now I've only got this little wedge, and then that gets noised out. Like if this was how much noise there is, If I get prematurely up in here, then I'm going to get noised out of that half the time at least, right?
Ken, what's the risk of being noised out and then just re-entering?
It's peace of mind and span of control, emotional cost of making lots and lots of decisions. So what I'm going to suggest is you want some kind of rule set that allows you to make the move from standard risk to no lose plus dinner for two in a rule-based manner. That you can now say, I've got 5 different rule sets that let me do that, and I can study each and every one of them. And then on the basis of analyzing the results, I can decide which one I'm going to use. And then I'm just going to live with that. That's doing the due diligence. So here's what I would say. The first one is just trail the 0.6R. Leave it alone. Your worst loss is going to be 0.6, so your average loss will probably be 0.3. Done in one. And if you trail with 0.6, if it moves out 0.9, then it gets to 0.9 and you're trailing with 0.6, you will have locked in 0.3, right? Not quite to scale. So by the time it gets to 1R in hand, and remember that means it's got to go 1.5 of those boxes, right, to get to 0.9. Because if that's 0.6, it's got to go 0.6 to get to break even, and now it's got to get to 0.9 so you can get to 0.3. So it's got to get to 0.9, and then you're good. And that can happen at any time. And what I will tell you is one of these conditions-based rules is you could say no matter which one of these I take, if I ever get an average trade, or greater than an average trade, so I just take my average trade to be 0.7 because that's 1/3 of the 2R that I'm shooting for. So if I just get, if I take my 2R trade and break it into thirds, and I get to 0.7, if I get to 0.7 and beyond, I don't care what rule set I'm using, I'm going to get to no lose plus dinner for two. And why is that? Because I'm going to lock in 0.2. And I've given it, and I still am giving it half of a risk box to get going. And then everything after this, I can trail that, and I'm good to go. So one of the things that I got to know is what is my average win, and then what is my average win plus 1 standard deviation. Because that's going to be, because 85% of my trades are going to be less than that. 85% of my production trades are going to be average wins plus 1 standard deviation of my winners. So that means if I ever get to average win plus 1 standard deviation, if it goes beyond that, I'm already at an exceptional, only 1 out of 6 trades even gets there. So now I'll bring in not the fireman, but I'm going to bring in my closer. I'm going to bring in Mariano Rivera. I'm going to bring in my expert to handle how I exit after it gets to average plus 1 standard deviation. All right. So that's taken care of the far side. So now let me come back to this earlier. So the first thing I can do is just trail 0.6. If I'm using the PSAR stop, I could actually trail with the PSAR. Now, when could that be a problem? It's a good problem to have, and that is if price from my entry jumps straight up and then starts drifting down. Because the acceleration factor on the PSAR limits how fast it can rise. Whereas if I took the maximum favorable excursion and then hung the risk box off the top of that, at this point, the risk box, the 0.6 risk box, gets me out here, whereas my PSAR stop gets me out here, and now the bogey is this little piece. That the thing that makes the PSAR really good at the end is the acceleration factor helps you on the far end, and that is when price goes up like this, it goes up a nice big move, and then a smaller move, and then starts petering out, and then starts decaying. You know, it looks like that. Whereas the PSAR, if you connect the dots, looks something like this, and then it cuts that at the end, but it gave it room to run. It gave it room to run inside there, right? So the acceleration factor governs how fast that move, how fast that thing closes the gap. So that's helpful on this end because it stops us from falling in love with the memory of, oh, this thing did so well back in the early days, so I'm going to stick around even though it's starting to decay. The PSAR is ruthless at the other end. And it says, dude, you're just getting out of that. It had a chance, and now it's over. But where it hurts us a little bit is in the fact that it has a, it's at its widest stop in the first third. And then the only reason that that's even a problem is, again, if you have this case where you had this giant move up, and I will tell you, that's where you get into the, I'll just say, if you get to 0.7, just command override and just put it at 0.2. But until it gets to 0.7, just trail. At 0.7, accelerate it to 0.2 or 0.3, something like that. It's actually pretty close, because if you're trailing with 0.6 and it gets to 0.7, you're kind of already at 0.1 anyhow. Maybe that's good enough. So the first simple answer, just trail with the risk box. The second one is follow the PSAR. The third one is what we call the FQA exit, and I'm gonna describe that now. But I have to clear the screen. Is that clear so far?
Yep.
So far, so good.
Fantastic.
Yep.
So the FQA exit had the problem that the PSAR came down, and then the PSAR goes up, and so you had this. You have this little piece right here, and your entry was here. Whoop, calibrate my eyeball there. So all what the Uwe exit does is this. It waits for 3 PSAR dots above that. And all it does is says, look, we were on this mission, especially like on 1 minute bars and 3 minute bars, to try to reduce the size of that box as much as possible. The shorter the time frame, the more important this is. And so on the 1 minute and the 3 minute, what we do a lot is this, where I just am going to leave this in place and leave it alone. I planted the seed, let it grow, and it needs that much soil. So the Uwe exit deliberately leaves the first position, or it leaves the initial risk just in place. And then when you get the 3 dots above the entry, this bar had to close, right? When that closes, then the 3rd dot is printed, and then on the very next bar, you raise that up to what is now the 4th dot. And then you leave that in place. Because at some point the Bollinger Band mean, which is the moving average 30, ends up turning like that. Because this was for all those like harsh winters and SSCs and all that shit, right? So your pathway looked like this. And then you picked up the Bollinger Band mean with 1/2 of the position, and then the other half, the aggressive one, was at some point the river is up here. Yeah. So the main idea of the Uwe is that it allows you to have a very, very tight stop, and you just leave it alone until the PSAR moves out of the yellow zone 3 dots. Now what you have is actual evidence that the trendingness of the price was able to pull the PSAR up to an acceptable level, and now it's in the money. And 3 dots seemed to be enough that on the 4th dot you just accelerate to there. You leave that in place until the Bollinger Band mean comes along, and then you follow with 1/2 the position on the Bollinger Band mean, and then you use an aggressive sniper stop like the PSAR dots, or the southern skin of the dragon, or your judgment that it's time to get out. And then you just take half the position with that, and you leave half on with the conservative Bollinger Band mean. And what you end up getting is the blended return. Now you don't have to make a decision on which exit to follow. Should I be aggressive or should I be conservative? Because you'll only remember the ones where you got it wrong. So you just say, look, once I get to that position and the Bollinger Band mean is now a reasonable conservative exit, I'm already got an above average win. So just take half of it with that, and then play with half the position with your sniper exit, we call him. Now the sniper can get out and get back in and get back out and get back in based on all the rules of Kata 2 and all that stuff. But it's only half the position, so the risk is less. And half the time the sniper will be right, and then you get a better blended exit because the sniper got out with half, and then it just continued all the way down and hit the Bollinger Band mean for half. So you got a little bit of improvement because you listened to the sniper. But sometimes the sniper is wrong and you get out, and then it sells. And then it doesn't hit the Bollinger Band mean, and then it goes back up. If you don't know how to re-enter, now you only got half a position that's going to be great. But if you know how to re-enter, It's the sniper mentality. I can get in and get out, but with half the position size, and I have the comfort and the smoothness of the Bollinger Band mean being very good, and that's going to give me my blended return. Now I don't have to decide one or the other. I can spend 100% of my time refining my sniper technique, and then I can look at the results later and decide what's the right thing to use for the sniper. Is it like the dragon horns that went outside of Z3? Should I exit when, like my brother says, the R10 crosses the baby dragon, just get out? Should I put a half of a wrist box on it because I got two positions on, which complicates it? Don't put two positions on until you have solved all these problems with one position. That's by far the best thing to do. It's better to take two different trades than to add that complexity. So the three things that I would say to study is, and then practice all three of those on the same chart. Mark them up with different colors so you can see what the flight path, what the pathway of each exit was at every moment that you were in the trade. Which one of those feels satisfying? That's how I got the PSAR tuned to where it is because I was doing all this shit stuff manually. And then after I was really comfortable with that, I went back to those trades and had the pathway of my exits on them. And then I tuned the PSAR dots, adjusting the parameter until the PSAR dots curve fit my satisfying professional judgment. And as soon as I did that, now suddenly a great weight was lifted off me, because now on a below average day, I could just trust the PSAR to be my bud. Because I proved that over 1,000 trades that I like the PSAR tuned to the RL10. That's why you'll see me say all the time, trust the PSAR. Sometimes I'll get out sooner than the PSAR. That's always a sniper exit, and I've learned to live with that. So
on tuning the when you were going through the trades and tuning that up,
yeah.
are you relating that to other stuff, other indicators, the market, a particular stock?
Those are almost always money management stops and pattern recognition on how far it's pulling back. Like when I get to the maximum favorable excursion and I see what my open gain is, my risk manager thinks that's my money, every single penny. And so every adverse move is starting to knock on the door, say, hey, are you paying attention? You know, that kind of stuff. So that's why I would say at some point, when you feel that already, just put a half a wrist box on it and let that be your sniper, and just tell them, sit down and shut up. Leave me alone. I'm going to keep half with the Bollinger Band main and half with that little wrist box, so shut up. What you may end up finding is that you could put half, when you get to that level of performance, you might put the aggressive sniper with half a wrist box, and you improve the Bollinger Band mean to the PSAR dot, or the southern skin of the dragon, or sometimes the northern. You see me arguing a lot on those, especially the collapsing dragons, and I say, look, that thing was already more than 1 hour in hand, and it gives you a 1, 2, 3 exit. Take the 1, 2, 3 exit. That's a good rule all the time. Or and so the sequence looks something like, if it goes past Z3 and comes back into Z3, don't stick around longer than Z-2. Don't let it cross 2 Bollinger Bands against you, because you just missed the gift. So if it goes past Z3 and comes back into 3, I'm almost always ready to get out of it right now, because it had to take a really large anomaly to get it past Z3. Because normally it just grinds up and the Bollinger Bands expand as it's moving up in an orderly fashion, so it never gets past Z3, except sometimes, wow, big move, large order, big gift, nobody else came in, it's starting to fail, it's a parabolic move, PSAR's too far away, take the gift. If I've already thought that much about it, just take it. You know? And so I'm not looking at any indicators at all on that decision. That is purely visual box trading and based on how much my initial risk was. Like, if I was willing to risk 50 cents before it started to work, and now this thing worked and it was +3, you think I'm going to give back more than my initial risk? No. Because that's 3 times better than I had any right to believe in. So I'm not looking at any indicator. That's why I really strongly recommend you try the visual box trading, because it will really sharpen your skills and your eyesight, and it'll build trust in your judgment. You just get comfortable telling the monkey to sit down and shut up. And then that's what you do when you have an abnormal win. That's a really good problem to have. But the trailing the box or just the PSAR itself, that's what Bill Scheit and Jeff Boccaccio do with the PRX system. They only take COTA 2 entries and they follow with the PSAR. Done. And I'm trying to coach them how to capture more of the outsized gains, but they just are content with their rules. So be it. They're younger than me.
Can I ask one question that I
Sure.
didn't submit it, but
Yeah.
whipsaws. I know the crocodile is, stay out of when it's the crocodile, but
Yeah.
very often I'm getting just whipsawed back and forth, and then because it's such a low time frame
Right.
spread.
So here's what you got to do. Everything has to start with a harsh winter, an unambiguous harsh winter. When you have an unambiguous harsh winter, that thing is so far out of the river that you're not anywhere near the crocodiles. That SSC works, and 1 COTA 2, and if it ain't working, then move on. And then just wait until you get a very clear Z3 pinch, which is smaller than a frog box. When the Z3 lines compress that much, you have an abnormal compression, and now the breakout you can trade, even though it was in the river. You can trade it because it's more important that it was abnormally pinched. So I take the SSC and 1 COTA 2. If neither one of those works, and I get a micro loss, okay, done. Leave it alone. That's simple.
Okay.
I have to, 2 strikes and I'm done. All right, let me get this processed. I got to edit this later, and I got to finish up the reports, and I'm not sure why it stopped the sketching. Sometimes when I do if I have the drawing program open and then try to put Zoom drawings on top of that, sometimes the mouse and the cursor get confused about what it wants, and I think that's what happens. So,
Oh,
So-
can I
Thank you,
just say
Ken.
something?
Really appreciate it.
go ahead.
Oh, feel free to be as brutal as you want to in the coaching lessons. I know it comes from a good place, and all comments are really helpful. So I really appreciate what you've done so far.
Yeah. Cool. Yeah, 100% of your time or 80% of your time should be spent on managing those exits in a way that you have documented with rules and gotten to the checklist level of detail, and then actually marking up your charts, not just the trade that you took, but the way the different rule sets that you're studying unfold, so that you're getting maximum educational value out of each case study. That's what going back and looking at the game film really is. The same way chess masters. He's playing a 3-minute game with a 2-second increment, but he spends an hour studying that 3-minute game because he's looking at combinations and what about this and what that. That's getting the maximum learning value out of the data, right? So that's what I would say. All right, that's everything I got. We'll get this edited and posted, and we'll see you shortly.
Okay, thank you.
All right.
Okay.
Thank you.
All right, see you guys.